Good. Let's see, what are we? Almost noon here. So good morning, good afternoon, good night. Here is going to be another episode of AM Daily Crypto via Crypto Potato Crypto News. A lot going on. I'm sure all of you have seen this little pump that we're seeing, and I am so excited about it. I actually did this video this morning at 6 a.m. I had my coffee, I was ready to go, and I did a whole 30 minutes, and come to find out Streamlabs was not recording. So I did a 30-minute run through this morning. We just run through the day, and we don't let small stuff hinder us. So with that being said, guys, we are going to start this over now, but I am seeing we have some more news channels. So with that, guys, let's get started. So back to this. I have my protein shake, so I drink 2 meal shakes a day and then a very small meal because my stomach does not like me. So a list with all other crazy medical issues I have going on. But before I start reading, remember to subscribe, and hit the notification bell on Twitter. That way we can get those subscribers up. Last time I checked, we are at 33, so we are slowly but surely growing. We would love to be at 100 before the end of the year. So if you could just and subscribe, obviously, to AM Daily Crypto. You can find us also on amdailycrypto.com, where we have some merchandise, some stuff for minors, some stuff for women, some stuff for people who do NFTs, etc. And you can also find us on Twitter at AM Daily Crypto on Twitter, as well as CryptoLissa, which is my personal account on Twitter. So let's get started. Celsius had serious internal issues years before bankruptcy, ex-executive says, written by Mandy Williams. Former Celsius senior executive have revealed the crypto lending company had been struggling eternally for years before going bankrupt, contrary to what the firm claims that its problems stemmed from the recent market crash. According to the employees, Celsius was disorganized and lacked proper risk management. Internal documents reviewed by CNBC showed that the leading crypto lender would invest in high-risk crypto projects and borrow money to hedge funds in return for higher yields. The firm would then share profits with customers. Unfortunately, the model failed during the recent market bloodbath induced by terrorist crash and news about the Fed hiking interest rates. The biggest issue was a failure of risk management. I think Celsius had a good idea. They were providing a service that people really needed, but they weren't managing risk very well, Timothy Cradle, Celsius former director of financial crimes compliance, said in an interview with CNBC. He also claimed that the company also failed to invest in compliance. The former director said he was a part of a 3-person compliance team at the firm between 2019 and 2021, and the division lacked enough resources to function properly. Cradle further revealed that the crypto lender manipulated the price of its native token Cell by actively trading and increasing the price of the asset. The pumping up of the token was carried out by the company's executives, who openly discussed it at a Christmas party in 2019. And I have a feeling this right here is not going to go over well with the SEC. I don't know about anybody else, but that right there is a little scary. quote, they weren't shy about it. They were absolutely trading the token to manipulate the price. It came up in two completely different conversations for two completely different reasons, he said. Another Celsius employee who wished to remain anonymous alleged that while Celsius was incentivizing customers to buy sell, the company's CEO, Alex Mashinsky, was secretly selling off his tokens, which I don't believe. I just didn't read, but skimmed over a news article yesterday where Ripple CTO or something, their upper class chief operating, I don't know, legs were selling off his Ripple and XRP. So I'm not surprised that the CEO of Celsius was secretly selling off his tokens, because obviously most people do that. I mean, is it the right way to go around stuff? No, but it is what it is. And obviously they will be seen in court or prosecuted, or who knows right now. The allegations from former Celsius employees align with those of the company's former money manager, Jason Stone, who sued the crypto lender for fraud, lack of proper risk management, and market manipulation. Meanwhile, a document from Celsius' first bankruptcy hearing revealed that about 77% of the crypto assets deposited on the platform belong to the company and not customers, which I will read another article. And this is why, not your keys, not your crypto. We say this all the time on this channel. Get your stuff off exchanges. Also, why I have a cold storage wallet. I'm looking at getting a ledger because I don't trust exchanges, and it's just here lately. It's just over and over and over again. And the other thing too that I'm really looking at is Voyager, for example. Voyager said that they were giving 9% of a month for USDC or USDT at the time. I don't even know. It sounded good, sounded great, but being a business major I am, I was like, okay, so where's this money going, and are we going to get this money if something happens? God forbid something happens. And so I never invested in it because I didn't believe it at the time. Because coming from a business degree, I'm used to banks giving you like 0.75% APR, whatever, on your savings account or CD, or you know what I'm saying? Like anything related to constitutional bank. So 9% to me, like, yes, that looks amazing. But at the same time, it's like, what comes back from that? So now we are seeing people like Celsius and Voyager and all these people that were semi-backed on 3AC, which kind of looked like they were just kind of, robbing Peter to pay Paul type of thing. And so now we're in this whole drastic situation where we have cryptocurrency exchanges now filing for Chapter 11 bankruptcy. And it's just, in the long run, it's not just the employees. It's that the employees are one losing the job, and the macroeconomics of the situation within the United States right now is not good. Inflation is at like 9.123%, something like that. So even your USD doesn't go as far as it used to. And so now, like, people were more inclined to go over to crypto because they're seeing this APR, right? But then shit hits the fan and all hell breaks loose, and now we are left with bankruptcy hearings, and you may not get your crypto back. You may not get that initial investment. You may not get anything back. And so, like I said, this last sentence right here, I will read in another news article. And just beware of what you guys are doing. It's like we always say on this channel, Please do your own research before doing any kind of investment, whether that's NFTs, crypto, stock market, futures, contracts, anything like that. Do your research. Make sure you are doing it properly, and just beware, watch your back, and that's all you can do, right? That's all you can do is try to be safe in this type of environment. Anonymous user bids 1 million USDC on Amazon.eth ENS domain, written by Andrew Zoravalas. Because I am a .eth on Twitter, I do follow several people that are .eth as well, and I am semi-in, semi-out of the Ethereum community. I know a little bit about what's going on in projects and stuff like that. I'm more inclined to know more about Ravencoin or any other crypto community I am in. However, I did see this going around yesterday. An Opensea user placed a bid for 1 million USDC on the ENS name of Amazon.eth. The offer is set to expire on Tuesday at 1500 EST. According to the listing page, previous offers to purchase the name were for only a few $1,000s each. For example, the next two most recent offers were for 4 wrapped ETH, or $6,000, and 6,200 USDC each. The name owner, 4761BF, initially bought the domain for 33 ETH in February of 2022. He owns 57 other Opensea items, primarily from the dice collection, randomized and weighted dice rolls stored on chain. He also possesses one other ENS name in Fortnite.eth, named after the popular battle royale shooter from Epic Games. Meanwhile, the individual making the offer owns about 20 Ethereum name service names. Multiple are related to Amazon, including one called Jeffrey Bezos.eth. The Amazon.eth name was created on August 2nd of 2017 and expires on October 16th, 2036. It was first registered on February 7th of 2020. Oh, February 7th is my anniversary with Xander. Ethereum Name Service, or ENS, provides human-readable names to different aspects of the Web3 world. These commonly include blockchain addresses, but can also pertain to IPFS hashes or website URLs. Like NFTs, ENS names can be bought and sold on secondary markets and are often used by crypto users as part of their social media profiles. For example, I am known as Crypto Lissa on Twitter, and so I bought the ENS of CryptoLissa.eth. So I own that. That is mine, and none of y'all can have that. Unless you're paying like 25 ETH for it. Then I may give it up. The largest purchase for an ENS name thus far was Pergym.eth. I can't even say that right now. Purchased for 420 ETH, last year, about $1.5 million at the time. Earlier this month, the second largest purchase in the history took place with one buyer spending 300 ETH on 000.eth. Pretty interesting. Over $600 million liquidated as Bitcoin price soars towards 23K. Again, written by Andrew Zoravalas. The crypto market continues its momentum this week. Yes, it is. We are going in the positive green direction. Now soaring up towards $23,000, a price point it hasn't seen in over a month. The sudden surge has liquidated over $600 million in trades. not surprised. As indicated by CoinGlass.com, about $630 million has been liquidated from the crypto market within the last 24 hours. More than half of that value, $377 million, was cleared from ETH trades, given Ethereum's especially pronounced bounce from Monday. Some suspect that Ethereum is rallying due to the excitement about Ethereum's merge update, which has now been given a specific date of arrival. Bitcoin now appears to be showing its own unique momentum, trading at $22,460 at 1520 UST. It quickly surged to $23,160 just 16 minutes later. At the time of writing, it trades at $22,853. So as we can see, dip, up, 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 dip, up, dip, up, dip, up, and then we're going back down. And this is done via TradingView. Let's see over here. Scaramucci Skybridge pauses withdrawals for a fund with FTX exposure. Shiny Hideka. Anthony Scaramucci Skybridge Capital has halted investor redemptions for one of its hedge funds, Legion Strategies. The fund, with $230 million in assets under management, or AUM, happens to be one of the smaller offerings of the investment firm. Since the peak of the 2021 bull run, several crypto assets, including Bitcoin and Ethereum, have plummeted by nearly 70%. In fact, crypto is currently in the midst of one of the worst market crashes in its a little over a decade-old history. That did not make sense. The broader stock market also crumbled. The falling prices have gutted a myriad of once established players, including lenders, stablecoin issuers, and retail and institutional investors alike. Sources familiar with the matter told Bloomberg that Skybridge's decision comes because stocks in private companies are relatively harder to dispose of. As per the latest figures, 20% of Legion Strategies holdings are in privately held entities. The hedge fund also owns 10% of crypto in its portfolio, gaining exposure mainly via other funds managed by Skybridge Capital, as per the filing with the U.S. Securities and Exchange Commission, or SEC. Besides Legion Strategies, private investments also include prominent crypto exchange FTX. During the bloodbath in the crypto market, followed by the Terra implosion and several platforms going bankrupt, Skybridge Capital founder Anthony Scaramucci revealed adding more Bitcoin and Ethereum to the firm's portfolio. Scaramucci's Skybridge was among the first hedge funds to move into Bitcoin a few years back. Since then, he has accelerated the move into crypto via various blockchain partnerships, including the one with NAX's trading platform. Lido announces staked ETH Layer 2 capability as Lido explodes 160%. ETH and DeFi 1.0 lead the market as Ethereum 2.0 merge narrative intensifies. Here is one that I wanted to read. NFT giant Opensea unveils Solana launchpad, also written by Shiny Hideka. Opensea announced kicking off the Solana launchpad to allow creators to host a new mint from beginning to end on the NFT marketplace. According to the official blog post, Opensea will guide creators to navigate all pre-mint activities and allowist minting for their community and supporters, in addition to all post-mint and secondary sales. The goal is to develop, quote, the best Solana experience, end quote, in the NFT ecosystem by allowing users to have custody of their NFTs. Quote, we're excited to start this program with 2 Solana creators as part of our Launchpad experience. We are excited to launch and learn with these first drops, and we're committed to expanding primary drops on OpenSea, end quote. The development comes 3 months after Opensea activated support for Solana. The NFT giant has been one of the top beneficiaries of the bull run that transpired in 2020 and 2021. It managed to score hundreds of millions in investor dollars, most recently at a $13.3 billion valuation. Holy crap, that's a big number. However, the growth has attracted a fair share of drama. Earlier last month, one of the company's former product managers was charged by the U.S. Justice Department and arrested for insider trading. Not surprised, anything at $13.3 billion valuation is going to have drama. Look at Amazon. Great example. Following the significant depression in the crypto market, several top industry players chopped their headcount to prepare for the crypto winter. Opensea was no exception. The marketplace announced laying off 20% of its workforce last week. Not surprised. Not surprised. This one, remember the last article I read about Celsius? This one. Listen into what Celsius legal team has to say. This is written by Jordan Lionchow. Celsius legal team argues that customers signed over their crypto. This is going to get good, guys. After about a month of hemming and hawing, Celsius Network recently filed for Chapter 11 bankruptcy protection. In the last month leading up to the pretense dropping, customers' access to their funds was cut off while the lender looked for ways to stay afloat. Now, following the first bankruptcy hearing on the 18th of July, which was yesterday, Celsius's legal team has allegedly floated a novel idea aimed at preventing a total collapse, claiming ownership over users' funds. Not your keys, not your crypto. Say it all the time, guys. This line has been repeated NASM ever since the MT Gox days years ago. Unfortunately, the warning seems to have been well placed yet again. A few days ago, I can't even say that word. I said it this morning, but now that I'm actually recording, I can't say it. Economicists predicted that Celsius investors might be left empty-handed after court proceedings are over. Intimidating. I can't even say that word today. I said it this morning, but again, because I'm recording, no, I can't say it. That Celsius was less of an asset manager and more of an unregulated bank. Do you guys see how this is a problem? And it's probably going to continue to be a problem. And I say this over the last week and a half. Get your crypto off exchanges. Get your NFTs off exchanges. It's just, I don't know how else to tell you guys. Celsius, quote, Celsius is not an asset manager. It's a shadow bank, and deposits in banks aren't even customer assets, let alone assets under management. Celsius's terms of use make it completely clear that customers who deposit funds in Celsius interest-bearing accounts are lending their funds to Celsius to do with it as it pleases, and it specifically says that in the event of bankruptcy, customers might not get all or indeed any of their money back. Really? I mean, really. That's all I have to say about that. Oh, my nose is itchy. It did not take long for this prediction to manifest itself in the real world. According to documents from the court case, the company's lawyers argue that many of the funds users deposited on the platform were effectively at Celsius's disposal, not their own. In the retail section of Celsius's business operations, 3 key segments are identified: the earn program, the borrow program, and the custody program. Out of these, the last one is the only section in which deposited funds are declared wholly under the purview of the users who made the deposit. Unfortunately for Celsius users, the custody section only accounts for about 4% of all deposits on the platform. The lion's share was made in the earn program, accounting for a whopping 77% of all deposits. What does this mean for Celsius users? Well, under the terms of use of the platform, title to coins is transferred to Celsius, and Celsius is entitled to use, sell, pledge, and rehypothecate those funds. The underlying legal language was helpfully explained by attorney David Silver on Twitter, who lambasted Celsius's defense and the hesitation to clearly define itself as a type of financial entity or other, noting the company's pivot towards allegedly redefining itself as more of a Bitcoin mining entity than anything else. Pretty interesting. For now, no statement has been made by the court regarding Celsius's claims in the current bankruptcy filing. Get your crypto off of exchanges. I'm going to continue to say it. And this one is just talking about how the bear market could last another 8 months. So with that, guys, we are at 26, almost 27 minutes, and I try to like to keep these right around 30, because I know it can be kind of like crazy. So with that, guys, I hope you have liked this episode, and if you've liked this episode, please like, subscribe, and hit the notification bell on YouTube, and follow us on Twitter at amdailycrypto, and go in and check out amdailycrypto.com for merchandise and some other fun stuff. So until next time, guys, have a good day.